So, ladies and gentlemen, welcome to the 13th Baffi lecture on mining and finance. We are very pleased to have here today Professor Darrell Duffie to give this edition of the lecture. Professor Duffie is a Dean Witter Distinguished Professor of Finance at the Graduate School of Stanford University, and my understanding is that he has always been there since 1984, so he knows the Bay Area very well. So before giving the floor to him, let me introduce him briefly, although it's not easy to do so. So I've known Darrell for over 20 years now, but I think I never looked at his CV so carefully as I had to do in this occasion, and I was quite impressed. So if you look at his curriculum, you can see that he is the author of over 100 contributions between articles and book chapters, and he has also written 8 books. He has published basically in all, or almost all, the most important journals. I could count something like 11 Econometrica, 7 Review of Financial Studies, maybe an equal number of Journal of Finance, Journal of Financial Economics, and so on. Moreover, he's also the author of many books, as I said, one of which being very important, entitled Dynamic Asset Pricing Theory. The book is dated 1992, but nevertheless is still quite used in the PhD programs around the world. His contribution, as you can imagine from the number, span over a wide range of topics, including asset pricing, derivative, financial risk management, fixed income security pricing, over-the-counter markets, and the more you can put in the list. Several of his contributions have been particularly important. One, for example, has granted him the Smith-Briden Prize in the Journal of Finance. And also he has had numerous appointments, not only in associations like the Econometric Society, where he is a fellow, but also he sits in the editorial boards of numerous journals, including Econometrica, where he has been for over 10 years, I've seen. But now he is also in the Journal of Financial Economics board. Darrell is an excellent academic, but he's not only an academic. He's one of the rare examples of academics that is able to combine academia rigor and the formal techniques with the policy relevance. So he's able to tackle important finance issues with rigor, and that's one of the reasons why he's here today, because his research is very important for policymakers. For that, he has been consultant in various international institutions, including the International Monetary Fund, but also the Federal Reserve Bank of New York and Chicago and so forth. He has been working for many private banks and financial firms, and I was very curious to see that he has been working also for the public prosecutor of Milan for the evaluation of swap agreement, but I couldn't see the year when you did this activity. So recently, Professor Duffie has changed a little bit the topics in the sense that he has focused more on how the recent financial regulation, in particular the new rules in the aftermath of the financial crisis, have affected the way in which financial markets work and whether financial regulation is appropriate or whether there can be something that can be changed, in particular with a reference to the issue of too big to fail. But today in his lecture, he will focus on one particular aspect of financial regulation. He will look at how the regulations affecting the capital structure of banks and dealers in particular, so such as capital regulation, but also leverage ratio, affected their working in liquidity providers and therefore the overall liquidity in the financial market, which is clearly one of the most important topics that is discussed also in policy circle in these days. So let me stop here. Let me give the floor to him. The lecture will last until 12:30. I understand you have an hour for the lecture, and then there will be a Q&A session. The lecture is entitled The Liquidity of Capital Markets Under New Banking Regulation, although I understand the title may be changing along the way. But please, the floor is yours, and thank you again for accepting the invitation to be here today.
First, thank you so much, Elena. Elena didn't emphasize enough, I think, how long we've been personal friends, and it's a great pleasure to be sitting here today in front of you with her. First, I want to thank the Banca d'Italia for this great honor. When I look at the list of previous speakers in this series, I'm amazed to be among them. I also want to thank Governor Visco for hosting me today. We just had a very interesting conversation. I'm just delighted to be here. Thank you, Governor. I also want to thank Eugenio Gaiotti, who's here somewhere, I think, who hosted me yesterday Eugenio, at the research department. We had very interesting discussions there, and I spent some time also at your research institute, the INAUDI. Before I begin, I also want to emphasize why we're all here today, which is to honor former Governor Paolo Baffi, former governor of the Banca d'Italia, and it was explained to me today by Governor Visco how important he was to the development of research in Italy in economics and finance, and especially here for many decades at the Banca d'Italia. And I see that a member of his family is here today. My objective is to explain some of the unintended consequences of these regulations with respect to new frictions we are seeing in capital markets. And by capital markets, I mean trading markets as opposed to traditional commercial bank lending. This is the form of marketplace that I'm focusing on today. Trading markets, which are over-the-counter. And as most of you know, these markets handle the vast majority of assets that are traded on financial markets, including bonds, derivatives, foreign exchange, commodities, many other financial instruments. Financial economists often focus on equities markets because they're more easily analyzed, very transparent. But in terms of the working function, daily functions of financial markets, bonds, swaps, and foreign exchange do most of the daily work. And frictions in these markets are very important. These markets are intermediated almost entirely by a small number of very large banks. So in the United States, for example, about 95% of swaps are intermediated by 5 large banks. And globally, 12 to 15 banks handle the vast majority of trade in bonds, swaps, foreign exchange, and other over-the-counter instruments. And something has changed since the financial crisis. The big change, other than the crisis itself, is new regulation, and that has changed the way that these markets work. And what I want to do in the next few minutes is to explain some of these changes and some of the things that can be done to improve the functioning of these markets. Now, as I get into this, I want to avoid any risk that you might think I'm anti-regulation. In fact, my first point is that these regulations have a tremendous benefit in financial stability, and that these benefits, coming especially from capital regulations and the Bank Recovery and Resolution Directive, the benefits dominate the costs that I'm going to talk about. So I would not think of rolling back these regulations in general. And there's some discussion of this, I'm not sure about in Europe, but in the United States right now, there's some discussion of attempts to roll back financial reform. I think the momentum behind these rollback moves has declined. I don't think there's going to be a very significant rollback. I think some of these regulations will be simplified a bit, but most likely the most important regulations that I'm talking about, which are capital regulations and recovery and resolution, will be maintained. So that's good news. But I do want to focus today on some of the frictions associated with these regulations that might be mitigated. So the first friction I'm going to talk about, when I get into the meat of this, is one associated with the leverage ratio rule, which is a capital regulation that is intended to be a backstop to risk-based capital regulation, but which does not look at risk. It simply looks at gross leverage. In other words, it requires a certain percentage of capital that's fixed regardless of the risk of the assets. And as you might expect, whenever you have a regulation to control risk, which is not sensitive to risk, there are likely to be some distortions, some unintended consequences. And I'm going to emphasize where those are most important and where and how they might be improved. And for those of you that are big fans of the leverage ratio rule, you might disagree with me. I hope we can discuss that at the end. Speaking of the end, Elena, I should. Yeah, 12, 12:10? Good, good. I'm going to be very disciplined about not going over because I'm actually more interested in your views than my own views. I already know my own views. The second implication of regulation is indirect. It's through the Bank Recovery and Resolution Directive in Europe. In the United States, this is called orderly liquidation, which means basically that it's no longer going to be the case, hopefully, that when a very large bank is on the doorstep of failure, that all of the creditors will be bailed out by government capital. That at least a subset, which are designated, will suffer losses, and therefore they will be more guarded about providing credit on cheap terms. And I will show you evidence that they have taken, that is, the creditors have, they really believe that these resolution directives will be used. I will show you very strong evidence of that. And because of that, banks are much more sensitive to the costs of buying assets and putting them on their balance sheets. Because now they have to pay funding costs, which are their credit spreads on funding these asset purchases. And the assets that I'm most interested in today are bond inventories, swap positions, collateral, things like that. And I'm not going to focus on commercial lending, traditional banking, although there are some implications there. I'm going to be focusing more on safe assets, like government bonds, repurchase agreements backed by government bonds, safe bank deposits, things like that. So I've just covered two types of regulations that have had a major effect on capital market liquidity, and those are capital regulation and recovery and resolution directives. There is a more direct set of regulations on capital market liquidity, which are in Europe called MiFID, Markets and Financial Directives, MiFID, and in the United States, this is covered under Dodd-Frank. By the way, I think Europe has done a better job than the United States on these competition directives, getting financial markets more liquid by encouraging more price transparency and more direct competition for the dealers in markets. The United States moved faster but less aggressively than Europe, and I think the European model is somewhat improved. I read this week that China will follow the European model when implementing its own version of financial competition reform. And so these competition reforms, making markets more efficient, will to some extent reduce the frictional costs associated with the capital regulations and the resolution directives that I'm going to be discussing. And I'm going to focus at the very end on where those competition regulations are leading to some improvement, but not enough, and what might be done there. Okay, so now I'm going to begin by talking about the impact of capital regulations. And I'm going to do that by a very simple balance sheet diagram of a major bank. So you can think of JP Morgan or Barclays or Intesa or another major bank that's active in global capital markets and trading. And this bank has a balance sheet of assets. And on the liability side, my diagram is going to show you the sizes of liabilities and equity in market value terms. That is, don't think of this blue rectangle as the principal amount of debt that's payable, but rather the market value of the debt. And as you can see, the market value of assets equals the market value of debt plus equity. And this bank, this hypothetical bank, is going to consider expanding its market-making inventories of assets. So perhaps acquiring bonds from its customers in order to provide immediacy to those customers, adding liquidity to markets. Or perhaps increasing its inventory of assets so that when a customer asks for a specific bond or foreign exchange position, that the bank will have that asset available for trade. So this means you have to fund these assets by issuing some securities, some equity or debt in order to purchase these new assets. So that's the situation depicted here, where the bank, anticipating a need for more market-making inventory or serving a customer's needs, adds some assets. And to make the story very simple, it's funded first purely by equity. This is to make the concept more simple, and then later we'll turn to the more normal case of funding with debt or with a mixture of debt and equity. And the reason I'm discussing equity first, not only is it simpler, but it goes back to a famous result called a debt overhang. So I want to talk about debt overhang by illustrating the impact of this purchase of assets on the market value of the debt of the bank. Now, if you have very good eyesight, you can see that. Let me go on to this picture. Actually, these slides are slightly different than the ones that I gave to the technician, but it's supposed to be show that the blue rectangle is actually now bigger than it was before. In the diagram you're looking at, it looks like it's still the same size, but in fact it's supposed to be bigger. Why is the new value of the debt bigger? Well, because now there's more assets backing the same debt, and the debt is safer, and therefore it's worth more. Okay, let me repeat. If you add assets and don't add any debt, the debt is safer. The old debt is safer. It's worth more. And it therefore must be the case for everything to add up that the equity is worth less. So this idea goes back to Stuart Myers in 1977. I think this idea is one of the strongest candidates in financial economics for another Nobel Prize. It's of under-recognized importance that there is a friction in purchasing, or in this case, in intermediation for banks. There is a friction associated with a capital structure in which the debt can increase in value when you purchase more assets. What this means is that for the bank shareholders to make money on this increase in market-making assets, it must be able to purchase the assets at a lower price than the cost in cost in terms of equity issuance. So if the bank is going to issue, let's say, $100 million of new equity to fund assets, it has to be able to purchase the assets for less than $100 million to overcome this transfer of market value to the creditors. Now I'm going to talk about the implications of this through the leverage ratio rule. So the most striking example is for the largest 5 U.S. major bank dealers. JP Morgan, Citibank, Bank of America Merrill Lynch, Goldman Sachs, and Morgan Stanley. What I'm going to plot here, and I'll explain this in detail, is the amount by which these banks exceed their requirements under the stress tests that are imposed by the Federal Reserve Board in the United States. So these stress tests are called CCAR and DFAST. So if you know those acronyms, they're basically annual stress tests to check on whether the bank has enough capital. On the vertical axis is the excess capital, the amount that the banks have in excess of what is required under the tests. And you can see that the excess ranges depending on a specific test and depending on how you measure. But what I want your eyes to focus on is the difference between the excess in red for risk-based capital requirements and the excess in blue for the leverage ratio rule as applied to U.S. banks, which in the United States is called the Supplementary Leverage Ratio Rule, or SLR. So again, red is risk-based excess capital available. Blue is leverage rule-based, non-risk-based excess capital available. You can measure this in two different ways. The dark red is the traditional CCAR test, and the light red is DFAST after making some adjustments. No matter how you measure this, you can see the blue excess is smaller than the red. Now that's the main message of this picture. That is, the leverage ratio rule is more binding on these banks than the risk-based capital requirements. Under the leverage ratio rule, these banks have just enough capital. Under the risk-based capital requirement called core equity tier 1 capital, the banks have much more available capital. So if you imagine yourself at one of these banks like JP Morgan, and you're thinking about acquiring more market-making assets, offering intermediation services to your clients, you're going to be more sensitive to the leverage ratio rule. You're going to say, well, I need to be cautious because if I acquire a lot of assets, I have barely enough equity under the leverage rule. I may need to add more equity. And going back to my reference to the theory of debt overhang by Stu Myers, if I have to add equity, I'm going to be improving the position of my creditors at the expense of my shareholders. Okay, so that's the message so far. That means these banks will be very cautious about adding assets to their balance sheet because the leverage ratio rule may cause their shareholders to lose money at the expense, at their expense. I'll give you a very stark example of this through the repo market in the United States. So this is the market, actually it's a global market for Treasury repurchase agreements, which is a funding mechanism for those that wish to fund their Treasury securities using repurchase agreements. So this is a type of asset that's held by major banks. And I'm going to show you the amount of repurchase agreements that are done by the large US banks. That's in red, and that's on the order of $500 billion over the last few years. And in blue, which is the European banks that are active in the US government securities repo market. By the way, this is from some very recent research by Egelhoff, Martin, and Zinsmeister at the Federal Reserve Bank of New York, and you can find it on their website. So if you focus on the red and the blue line, you'll notice a difference. The red line is relatively flat. The blue line has a very funny notch at the end of each quarter. Every 3 months, the blue line goes down quite dramatically, and at the end of every 3 months, it comes back up again. Why would, most of you are in central banks or have bank supervisory functions. You can see now the bite of the leverage ratio rule on these banks. You can see it in the European banks directly because they're only measured for the leverage ratio rule at the end of each quarter. You can't see it in the red line, but it's there. The red line is basically lowered at all times because the US banks are measured for compliance with the leverage ratio rule on an average daily basis. So here I'm not focusing so much on whether you should measure at quarter end or on daily end. What I'm focusing on for this presentation is the fact that the leverage ratio rule must be a source of constraint on the provision of liquidity because you can see exactly when it binds at the end of quarters on the European banks. Now, if you're interested in how cash investors compensate for this lack of provision of liquidity by European banks at the end of each quarter, you can put your eyes on the green line and see that the Federal Reserve has set up a different facility called the Reverse Repurchase Facility, which offers a compensating source for cash investors of repos. But that's not, again, not my point. My point is we have very strong evidence that the leverage ratio rule does change bank behavior in a fairly significant way, and it changes it most directly for safe assets like Treasury repos. These are extremely safe positions. It changes it most for those because, going back to my debt overhang story, if the assets that you add to the balance sheet are extremely safe, then the market value of the debt is increased even more by the safety of the assets. And therefore, the transfer of value from equity to debt is even greater when you're doing safe assets. I'm going to give you more examples of this. So this is the picture, the same picture now, but it's for repurchase agreements. On the left-hand side diagram, before the regulation is the left-hand side. There's no need to add additional equity capital to do a repo, because under the old regulations, the risk associated with doing repo is almost zero, and so no need to add equity. On the right-hand side, in order to do more repo, you have to add more equity under the leverage ratio rule. That makes the debt safer, and that makes the market value of equity less safe. And that means that equity shareholders would say, please don't do more of this repo, because all we're doing is making our debt safer at our own expense. We're reducing our return on equity. How about the shareholders speaking through the board of directors, through the CEO, how about if our trading desks focus less on Treasury repo and more on risky asset intermediation? And that's the distortion that's being caused. Here is the evidence of this distortion directly in terms of prices and quantities. The left-hand side picture is the bid-ask spread on Treasury repo conducted by the major US banks. Before the supplementary leverage ratio rule, the bid-ask spread was on the order of 3 basis points with some very minor fluctuations. After the supplementary leverage ratio rule, the bid-ask spread grew quite dramatically to 16, 17, 18 basis points. On the right-hand side figure, you can see the impact of that increase in bid-ask spread on the volume of repos done in the interdealer market. Without going through this in detail, if you simply cast your eye on the right-hand side diagram, there's no doubt that the volumes have declined quite precipitously because of the supplementary leverage ratio rule. If you're curious about what has happened in the last few months to mitigate this problem, it's a long story, and it's related to the reform of the US money fund industry, which has forced a lot of repurchase agreements, new repurchase agreements with non-bank dealers. But that's a longer story. The short story is there are clear distortions in the Treasury repo market that are being caused by the leverage ratio rule. Now, what could one do? Well, certainly I would not advocate lowering the capital requirements of banks. The total amount of capital is beneficially high. It should not be lowered. So if I were to say the leverage ratio rule is not doing a good job because of this distortion, and I were to say we need to keep capital at least as high in total as it was, then the only thing that you could do is increase capital requirements somewhere else. There's 2 ways to do that. One is to make exemptions for very safe securities under the leverage ratio rule and increase the headline leverage ratio requirement. Say in Europe, I believe it's 3%. You could increase it, I don't know, picking a number 4%, but exempt very safe securities like government securities, repos, and things. Or you could lower the leverage ratio rule and increase risk-based capital requirements to compensate so that the total amount of capital in the banking system stays at least as high. Now I'm going to turn to a surprising effect of the bank resolution and recovery directives, failure resolution, and I'm going to give you evidence of an effect of this through funding costs for banks. So I'm going to do this, and I'm going to go through this diagram very slowly, don't worry, I'm going to look at evidence in the form of violations of the law of one price in dollar funding markets. And this, the bankers call this a cross-currency basis, meaning the interest rate for borrowing in US dollars of the same quality globally varies as the form of dollar borrowing varies. I'll give you a concrete example. JP Morgan or any global bank, let's say Unicredit, for example, or Intesa, or Societe Generale, these firms can borrow dollars directly by issuing dollar liabilities, or they can borrow dollars indirectly by issuing, let's say, euro liabilities and swapping the obligation into dollars so that they have a synthetic dollar borrowing. And the law of one price suggests it shouldn't matter, that competition and efficiency of markets should drive the interest rate for borrowing directly in dollars to the same level as for borrowing indirectly in dollars by foreign currency borrowing converted with derivatives into dollars. Should be the same as long as the quality is the same. It was essentially the same interest rate before the crisis. So the violations of this rule, this law of one price, which is called covered interest parity, violations were tiny before the crisis. Then the financial crisis hit, and economists like myself said, the covered interest parity has failed because markets are broken. It's a crisis. It's a panic. Nobody wants to do these trades anymore. But that wasn't the, it might have been a temporary explanation. It hasn't explained why these violations of the law of one price continue. Covered interest parity is still failing today. In the research on the left-hand side diagram by Federal Reserve economists Wen-Shin Du and two collaborators, Tepper and Verdalen, they show convincingly that across all maturities, all major G10 currencies, there are very significant violations of covered interest parity, indicating something has happened. There's a new friction in capital markets that prevents banks from arbitraging this failure of same interest rate for same borrowing. And the right-hand side diagram basically explains the story. The right-hand side diagram shows that credit spreads for banks have gone up dramatically since the crisis. Pre-crisis, these are in 5 years. I'll show you short maturities in a minute. 5-year credit spreads, in this case represented by credit default swap rates, were nearly zero before the crisis. And now they're quite a bit higher. Whether you're looking at European banks or US banks, credit spreads are much higher. And this should strike you as puzzling at first because bank capital is now much higher than pre-crisis. Because of capital regulation, banks are much safer now. Why should creditors be demanding higher compensation for bearing credit risk from banks when banks are much safer? Should have gone the other way, no? And the resolution of this puzzle is BRRD. The fact that those of you that are regulators in this room and are involved with the failure administration of unsafe banks know that these banks, the creditors of these banks, are no longer fully protected by government capital. They are assuming that they are going to suffer losses if a bank becomes unsafe. Now, this need not necessarily happen in every case, but as long as creditors believe that they are subject to losses at failure, they will charge higher credit spreads. So even though the banks are much safer, the credit spreads are much higher. This is also true at shorter maturities like 3 months. I think I have a 3-month picture. here. Well, I'll show it to you later. There's a 3-month version of this picture. It's the same. At 3 months, 6 months, 1 year, credit spreads are much higher. Why should this matter? Because the credit spreads are the cost to the banks for conducting an arbitrage of this covered interest parity violation. Let me go through that very briefly. Here is the arbitrage that the bank could conduct. And by the way, this has nothing to do with capital regulations, which surprised me. This is from some research that I'm doing with Leif Anderson and Yang Song. This new friction in capital markets has nothing to do with capital regulations. It has to do with bank recovery and resolution directives. Here is the arbitrage that perhaps Société Générale would conduct. It would add a dollar asset by investing in euros and swapping to dollars, and create a dollar liability by borrowing in dollars of the same amount. Given recent violations of covered interest parity, this is going to earn the bank a profit of roughly its credit spread, and I'll explain that. So if it's JP Morgan, credit spread is 35 basis points for 1 year borrowing. I'll show you in a moment that this trade will be profitable by about 25 cents, but the bank still will not do the trade. The bank will find that there is a debt overhang cost to its shareholders associated with conducting this trade. And that transfer of value from equity to debt is known in industry practice as a funding value adjustment. The bank, in conducting this arbitrage, will need to make a profit that exceeds this funding value adjustment in order to justify the trade for its shareholders. And that is a wedge, a friction in capital markets that is there because bank credit spreads are much higher than they were before. Here is a numerical example. So we are the managers of a large bank. To make the calculations very easy to follow, let's suppose that the risk-free rate is 0. It's slightly negative in Europe, it's slightly positive in the US. Just to make it easy, let's suppose it's 0. And suppose our bank has a credit spread of 35 basis points. We're going to conduct an arbitrage as follows. We're going to borrow $100 with 1 year US dollar commercial paper. And because our credit spread is 35 basis points, we have to pay back $100.35 in 1 year. Now we're going to invest the proceeds, $100, in a euro deposit, let's say euro commercial paper, and swap it back into dollars so that the credit quality of this euro swap to dollar asset is exactly the same as the credit quality of our liability, so that I can make an apples to apples comparison. And because of a failure of, of covered interest parity, this new asset is going to pay $100.60 for a profit of 25 cents. That means the cross-currency basis is minus 25 basis points. That's the 25-cent profit. This is a real profit to our bank's balance sheet. However, it's not a good idea for our bank shareholders. Why? Let's focus on the bottom line, the very bottom bullet point. How much do the shareholders make from this trade? There's two possibilities. Somebody has a phone call. Two possibilities. One is the bank survives, and the full liability of $100.35 must be paid. In expectation, the asset, because it has the same credit quality, is worth $100.25. That's the $100.60 discounted by a 35 basis point credit spread. So we have an asset which pays an expectation conditional on survival, $100.25, but our liability conditional on survival is $100.35 for a 10-cent expected loss to shareholders if they survive, if the bank survives. If the bank fails, the shareholders walk away, they get nothing. So no matter whether it's survival or failure, the shareholders make nothing. They either lose or make nothing. The 25-cent profit is going to the creditors. They have an additional asset backing their claims in the event that the bank fails. Now, the failure probability doesn't need to be very high to drive a relatively wide bid-ask spread into this market, allowing relatively wide arbitrage bounds on the cross-currency basis. Cross-currency basis, according to the best available research, has averaged about 25 cents across all major currencies and all maturities for the last few years. And this is not a capital regulation issue. This is, again, because bank credit spreads are higher now than they were before, despite the banks being safer. And that is because of a success story of BRRD. The success story of BRRD is now creditors will not give banks very cheap credit, assuming that they'll get bailed out. They are charging the banks higher credit spreads in light of the fact that they may be part of the loss-absorbing capacity of the bank and in the event of its failure. They have a giant target on their back. I'm going to skip the detailed calculations and show you that there is also, on top of what I just described, an additional regulatory capital friction. And again, you can see it at quarter ends. So here, in the middle of each quarter, there is a substantial basis of about 25 cents in dollar yen. That is, there's a violation of the law of one price for dollar borrowing relative to synthetic dollar borrowing using yen of about 25 cents on a daily basis across most maturities. But at quarter ends, this violation becomes very extreme. And because at quarter ends, regulatory capital requirements, especially the leverage ratio rule, are biting very hard on major global banks. So this picture shows both of those frictions. These credit spreads are higher in both Europe and in the US and at all maturities. So here is the one-year credit spread as shown by the difference between one-year Euribor and one-year overnight index swaps, or one-year LIBOR and one-year overnight index swaps. Both in Europe and the US, credit spreads have gone from near zero pre-crisis to substantial levels post-crisis, despite higher capital. I added a picture showing the situation for two large Italian banks that are active in global markets. Those are Unicredit and Intesa Sanpaolo. And you can see that those two banks are suffering from the same funding costs or even higher funding costs as those of the average European bank. This is at 5-year maturity as evidenced by credit default swaps. So all major global banks now find it more expensive to add assets to their balance sheet for two reasons. One, if it's a safe asset, the leverage ratio rule makes it very expensive. Number two, for any asset, higher funding costs due to BRRD make it more expensive to add assets to the balance sheet. The combination of the two means that it is more costly to provide intermediation services to capital markets through the balance sheets of the largest global banks subject to these requirements. So in the last few minutes, I want to focus on what we can do about this by redesigning our capital markets and, if necessary, changing regulations. The only change I would make to the two regulations that I mentioned, which are capital requirements and BRRD, is to adjust the leverage ratio rule so that it's less distortionary. However, there are other things that we can do, the most important of which is not to rely so heavily on these very large banks for intermediation services. Try to work around their balance sheets, and there are different ways to do that. Some of them involve financial engineering, some of them involve more competition, more involvement of non-banks in the intermediation of capital markets. Let me focus on those last two things in the remaining minutes. So first, to financial engineering. One way that we can make less intensive use of bank balance sheets is to involve financial market infrastructure like central counterparties, so that banks can take long and short positions which are blowing up their balance sheets and put them at a central counterparty where they can be netted, lowering the size of the bank's balance sheet. So the bank can continue to conduct the same amount of trade, same amount of intermediation, but with a smaller balance sheet. Some calculations I did a few years ago with Haoshang Zhu of MIT showed that this will only work if you do enough of it. If you do a small amount of this, it goes the wrong way. It's a long story, but there has been a significant amount of success in this area in standardized swap markets, and that's coming about through one of your MiFID directives, and also through the introduction of central clearing for other financial instruments like repos. Europe is ahead of the US on central clearing of repos, and that the US has been trying to achieve what you have done by introducing central clearing for repos, which would be very beneficial, especially given what I've explained earlier today about the friction in repo markets caused by the leverage ratio rule. Another technique from financial engineering is called compression, and I'm going to explain this by a very simple example. Compression is eliminating redundant counterparty exposures that serve no purpose in creating a net position for a bank. So on the left-hand side diagram, I have 5 major dealers, and I've concocted a simple example in which dealer 3 has a position of 60 with dealer 2, dealer 4 has a position of 40 with dealer 3, and dealer 2 has a position of 50 with dealer 4. And you can see there's some redundancy here. If you look on the right-hand side, the net positions are really only 20, 0, and 10. If you could get rid of the long and short that is redundant for each pair of dealers. That is, in the green dots on the right-hand side, we have the same net exposure to the underlying risk for each bank, but lower counterparty risk. How do we achieve the picture in the green dots, starting with the blue dots? Well, obviously we want to initiate a reverse circle of countervailing trades. We want to eliminate the redundancies by sending a circle of trades in the clockwise direction of size 40. So if we could simply get all of these dealers to trade 40 in the clockwise direction, every pair does 40, we would get the green dots. But the dealers are not going to do that on their own. They're not even aware of this circle of redundancies. They know their balance sheets are too big. They're not aware of how to reduce them by eliminating these trades because they don't know the entire network of positions. How was this resolved? And this was not done by regulation. This was a private sector initiative that was helpfully pushed along by regulation. Because of bank capital requirements and MiFID collateral requirements, the banks were suffering very high funding costs and capital costs associated with these redundant positions. They hired independent contractors to collect data on the entire network of positions. So one firm, for example, called Trioptima, has contracts with all the major dealers. The dealers provide to Trioptima all of their dealer counterparty exposures. Trioptima runs a computer algorithm that searches for circles of redundant positions and then initiates trades for all of the dealers of the form that I just described. So in this example, Trioptima would send a message to dealers 2, 3, and 4 saying, conduct the following sequence of trades of 40, size 40 each with each other, so as to achieve the positions on the right-hand side. And the banks, of course, will immediately follow these instructions because they're left with the same net positions, but lower counterparty exposures. Up until this year, Trioptima has already accomplished 1 quadrillion, more than 1 quadrillion of eliminated notional swap positions through these compression trades. So I'm not sure what the word quadrillion is in Italian, but it's a very big number. It's 1,000,000 billion, 1,000 trillion. It's a huge amount of balance sheet space that has been eliminated with no change in net exposures, creating massive reductions in capital requirements and collateral requirements because of the pressures of capital regulation. That's a big success story, and that sort of financial engineering success story is one way to mitigate the frictions that I've been talking about. Now I want to turn to the other way to do that, and that is disintermediation of the dealers, or more competition for the dealers. And then I'm going to skip that. Then we'll have time for Q&A. Okay, so if we wanted to make less intensive use of bank balance sheets, we would have all-to-all trade wherever it's feasible. So this diagram illustrates that instead of going to a dealer to conduct a trade, you could go to a platform with a central limit order book, for example. CLOB stands for Central Limit Order Book. And anyone active in the relevant capital market could trade with anyone else. This is called all-to-all trade. And dealers can participate on these trade platforms just as they participate today on equities exchanges. But others could also participate in providing quotes so that the most efficient quote provider would win the auction for the trade. And if the bank could not afford to use its balance sheet space to provide competitive quotes, then it would not win the auction on this all-to-all trade platform. MiFID, and in the United States, Dodd-Frank and Japan, have all initiated competition regulations for capital markets that encourage the migration of trade from the bilateral over-the-counter market onto trading platforms. And that is a big benefit in terms of not only reducing the too-big-to-fail aspect of banks, but also in terms of providing more efficient, more liquid capital markets. However, the job is not done. I'm going to explain why. First, of course, there are many financial instruments that are not suitable for exchange trading. Those are customized positions, exotic bonds, and so on. There are many other financial instruments that are standard enough to be traded on exchanges or other forms of all-to-all platforms, but currently that has not succeeded. What we have instead are multilateral trading platforms which help only a little bit. Here's how they help. Now we have more competition. Wherever MiFID mandates the use of a trading platform, a multilateral trading platform, rather than one-to-one bilateral trade, the dealers must compete against each other, and the customer will get a better price. So that's the current most common direction of movement associated with MiFID is movement of some trade from the bilateral OTC market onto these platforms, which are called request for quote platforms, where the customer comes, requests for quote, the dealers provide quotes, and the customer takes the best. Notice that the dealers are still on one side of every trade. There is no all-to-all trade. Customers, ultimate buyers, and ultimate sellers are not meeting. We're always intermediating with a bank position. So that's not avoiding the bank balance sheet. The bank balance sheet is still implicated. We also have a problem here with what's called fragmentation. We have multiple trading platforms for the same financial instruments. So whether it's corporate bonds, swaps, foreign exchange, government bonds, the customers need to shop at multiple different platforms, and that introduces a lack of competition relative to the best case. So wherever possible, this fragmentation should be reduced. Some of that is due to rigidities in the market, and some of it is due to cross-border concerns. So I noticed that Commissioner Giancarlo, the head of the CFTC, recently suggested more cooperation would be helpful. One of his predecessors was actually not very helpful in providing as much cooperation with other regulators on setting up cross-recognition of trading facilities and central counterparties. So this could be improved. If you could get less fragmentation, you would have more dealers competing on the same platform. And evidence of this improvement in competition is already available in some research by Terry Hendershot and Ananth Madhavan. They used the corporate bond trading platform data available on US corporate bond market to show that execution costs shown on the vertical axis go down dramatically as the number of dealers competing for quotes goes up. So what you really would like to do in order to improve competition, lower the costs of providing immediacy, is to get more dealers competing on the same platforms, or even better, wherever possible, all-to-all competition. Now, I have a slight conflict of interest in suggesting this because I was involved as an expert last year on a private litigation matter in which the largest dealers in the United States were accused of colluding to prevent the emergence of platform trading or central limit order book trading. And I just want to alert you to that. This case settled last year by the large dealers paying $1.8 billion in settlements. It did not go into court. And so I'm under non-disclosure. I'm not allowed to tell you all the case evidence involved. But I found the allegations realistic. And I think if regulation doesn't go further, then perhaps private litigation will go further in encouraging more movement away from the bilateral market where the local monopoly of dealers facing customers is reduced. And so that would be beneficial. The current situation that we face, however, is what's called a two-tiered over-the-counter market, where customers in blue can contact a dealer directly and do a bilateral trade, or they can contact a dealer through a multilateral trade platform and get a certain amount of competition, but not complete competition. Meanwhile, the dealers themselves do have access to inter-dealer limit order book or all-to-all markets, but rarely do customers have the opportunity to trade on those all-to-all platforms. So the customers are still getting all of their intermediation done by a dealer, and that means we're still using dealer balance sheets more than we need to. There's excessive use of dealer balance sheets. Those balance sheet sizes should continue to shrink, not only from financial engineering techniques like compression, but by further competition for customer trade. So that's the end of my prepared remarks. Just to summarize again, 3 areas of regulation which have been very successful in reducing financial risk, crisis risk, improving financial stability, and improving competition, capital regulation, bank resolution and recovery directives, and MiFID-like reforms to improve competition in capital markets, but more room for improvement through adjustments in the leverage ratio rule and through further moves to create competition in the capital markets like bonds, swaps, foreign exchange, and the like. Okay, so let me at this point invite you to disagree with me or provide your own comments or ask questions. Thank you.
So thank you, Darrell. This was an incredibly fascinating lecture, and I'm amazed by your incredible clarity also in talking about topics that are certainly not so easy to grasp. So now let me open the floor for questions. Please. Professor Dean.
Professor Duffie, I'm fascinated by your in-depth analysis of the effects of regulation and all the things you said. But looking from outside, I draw the conclusion that banking today has become a very complex business. And I have three questions that you can answer very, very briefly. First, what do you think about the Paul Volcker Rule? Second, do you agree that bank executive board are obliged to spend too much time on how to comply with regulations? And third, too big to fail?
Okay, those are excellent questions. Can I ask your name, sir?
I'm Lamberto Dini. I have been in Central Bank of Italy for quite some time in the past. Thank you.
Thank you, Signor Dini. Thank you, sir. Okay, so fantastic question. So let's start with the Volcker Rule. I actually made a submission to the US government in response to the introduction of the Volcker Rule, and I presented my submission to the various government agencies involved, arguing that while it has the correct goal, the correct intention, and the correct principles, it's extremely difficult to implement in practice. And it has caused more distortions than benefits. So the main problem is identifying what is a speculative trade that has no market-making purpose, no design to help clients achieve liquidity, from a speculative trade which is designed to help clients meet their trading needs. Separating the intention of the bank between market making and proprietary trading is extremely difficult, and because of that, you get distortions of two types. One is the bank, fearing that its trade may be misclassified, will reduce market making. The other is compliance costs, which you referred to. In the United States, the Volcker Rule is under reconsideration. Even governors of the Federal Reserve System have said that there are unnecessary, unintended consequences, and it needs to be adjusted. There have been some calls for repealing it, but I do not expect it to be repealed. I do expect it to be simplified and to put less emphasis on trying to separate proprietary trading with no market-making purpose from market-making. Another aspect of your question is effectively the separation of, well, let's say, Glass-Steagall type of separation of traditional banking from provision of capital market services. And the Glass-Steagall Act proved to be a failure in doing that. It was eventually effectively repealed. And today, in modern capital markets, it's very difficult to achieve an efficient separation of global banking from provision of capital market services like trading services. You can do it at the smaller bank level, at the very large bank level. It's a very costly separation, so I would not advocate that. I would advocate what you're doing, which is very strong capital regulation, progressively stronger as the bank gets bigger, so that one of the GSIBs, the globally systemically important banks, is required to have much more capital per unit of assets than the smaller banks. You could go even further in this direction without causing very much difficulties, I think. That alone would take care of some of the too big to fail problem that you mentioned, because banks would have less incentive to grow extremely large under the severity of higher capital requirements. The other way to mitigate this problem is what I referred to as the bank recovery and resolution directives, through very high capital requirements and through a method for resolving extremely large banks when their solvency is a matter of concern. The too big to fail problem, I think, it can't be completely cured. We will always be at risk of large bank failure, but it can be significantly lowered. We don't need banks that are in excess of perhaps 2 trillion euros in balance sheet size, but we probably do need banks on the order of half of that to provide sufficient liquidity for global issuances, for merger and acquisition activities, for efficient provision of intermediation in assets that require a lot of long and short positions on the same balance sheet. If you split up these positions across many balance sheets, you lose the benefits of netting. I hope I've done something for your question. Thank you. Thank you, Mr. Dini.
Thank you very much. Other question, please, here in second row.
My name is Rainer Masera. I'm very pleased to have had this opportunity, and I thank you and I thank the Banca d'Italia for this incredibly interesting occasion. Two brief remarks. The first one, the debt overhang problem. From a formal point of view, it was Miller who stated this very clearly well before Myers. He said, making the case you made today, that putting extra capital would be like putting gasoline into another man's car, and he was making this as an example of how shareholders would hate the idea of having excess capital because they would provide a resource to debt holders. The second point, I totally agree with some of your conclusions, not necessarily with the basic conclusion, that is to say that capital regulations are free of default themselves. And there are obvious reasons for you yourself indicated that it was not accounting the premise of your reasoning, but it was market accounting. So it was not book values as the Basel framework, but it was market value. And this, by the way, goes again back to the idea of Modigliani-Miller, because if Modigliani-Miller are right, the accounting in the Basel framework has no reason to exist. The final point is the following. While I take your point that it's easy to game rules in terms, and it's easier perhaps in terms of leverage, it is by no means obvious that you cannot game rules within the capital framework as it stands now. Indeed, as you know better than I do, the gaming of the risk-weighted rules was the preferred game for a number of years, and it continues even now. So I welcome your conclusions, but I think that perhaps your emphasis on risk-weighted, a critical emphasis, while you criticize fully the leverage, is perhaps a bit unfair. Thank you.
So thank you for those comments. Let me start with Merton Miller, a giant of the field. I'm going to enter into Google Merton Miller gasoline in another man's car, and I'm going to find the source and begin to cite his earlier emphasis on the importance of this point. He already got the Nobel Prize, so we can still suggest Stuart Myers for another one. My very first job interview was with Merton Miller. I can't say enough good things about his work, also with Franco Modigliani. Well, your second point, I think it stands for itself, and I don't think I'm going to elaborate on it. It's a comment that I need to study more, but in principle I don't disagree with. On the third point, which is the essence of which is risk-weighted capital requirements are subject to gaming. Absolutely, yes, especially based on internal models. Also, regulators game risk-weighted capital requirements through the lack of differentiation of risk weights on sovereign bonds, or essentially zero risk weights on sovereign bonds. So one way to mitigate this problem of gaming and get some of the benefits of the leverage ratio rule without some of the costs that I mentioned is to introduce a floor on the risk weights, so that not as high as the leverage ratio floor, so that if you're a big fan of owning sovereign bonds, they wouldn't be as penalized under the floor system as they would be under the leverage ratio rule, but still a floor that would mitigate some of the gaming. And also an additional method of mitigating this problem is to, at the aggregate system-wide level, monitor the total level of bank capital on a leverage basis. And when you see the total level of capital lower than it would be under the leverage ratio rule, continue to increase risk weights until the total level of capital that you would like to see under the leverage ratio rule in the system is high enough. Why is this better? It's better because each individual bank will then not internalize the distortion associated with the leverage rule. They will be internalizing the costs of meeting risk-based capital requirements, but on a system-wide basis, you'll have sufficient capital, the same amount of capital that you would have had under the leverage ratio rule. So those are some approaches that I think might achieve a better balance. Right now, I think we're too far inside the efficient frontier of financial stability and market efficiency. And we can go further towards higher efficiency without losing stability, or alternatively, get more stability without costing efficiency. Does anyone else have these are excellent comments, by the way. Thank you.
My name is Oscar Arce from the Spanish Central Bank. Professor Duffie, thank you very much for the very interesting lecture and for the clarity as well. So my question relates on, is about the practical relevance or the order of magnitude of the friction about the leverage ratio that you were emphasizing at the beginning of your talk. I mean, if I understood the argument behind this debt overhang theory, the introduction of a leverage ratio, if anything, would provide incentives for banks to move to riskier assets portfolios, right?
Correct.
But I mean, then when I look at the results of the U.S. stress test that you were plotting in slide number 8, I see that the measures of excess capital, when you take into account the risk profile of the assets, are relatively high. I mean, my interpretation is that U.S. banks are not really exploiting all their capacity to move towards riskier asset portfolios. I mean, in Europe, many people would think that European banks are not very keen to take on new risks. On the contrary, they seem very shy to take new risks. And also at the aggregate level, I think it is clear we are still living in a situation in which the demand for safe assets is very strong, even by banks. So putting all these pieces together, I wonder how relevant is the friction you were emphasizing and your criticism about the leverage ratio at this more aggregate level. Thank you.
Great question. So first of all, some evidence does exist of a shift towards riskier assets. So, for example, for the largest U.S. banks, data from the Federal Reserve Bank of New York show that there has been a 20% increase in risky assets relative to low-risk assets since the introduction of the leverage ratio rule, which is not huge, but it's still a moderately large shift. Secondly, if you were to expect a distortion from the imposition of the leverage ratio rule, then you would expect it to be more binding than the risk-based capital requirements. Because if the distortion is causing a wedge at the point of too little intermediation of safe assets, then the leverage ratio rule should be more binding than risk-based requirements. As to how much headroom, how much excess the banks have, that's these particular banks, especially the best capitalized banks like JP Morgan and Citi, are well in excess of the risk-based requirements that they have. So they have excess capital. For them, it's a form of business strategy to be very well capitalized. And they are actually winning business because they have lower funding costs than the banks that have less headroom. So the second part of my presentation, emphasizing funding costs, shows that it's a big advantage to have excess capital if it already is there. It's hard to raise it, but if it's already there, it's a big advantage.
Thank you. More questions? Governor Visco. Can you give him the microphone?
Thank you very much. It's a very interesting election. There are many questions that one may wish you to answer, but one which I'm not sure I understood is how large is all this? You have the credit spreads chart here, and you have this funding cost wedge and the arbiter bounds, and you show this spread, how it increased after the global financial crisis. As a matter of fact, there are two substantial increases, one after the global financial crisis and that during the sovereign rate crisis, sovereign debt crisis. And then, at least if you see the spread in Europe, you see that it goes back to some well, this is for Intesa. The previous one is the one which I was mentioning. Yeah, that one. Now, so you have a difference basically between before the crisis you had a few basis points. After the crisis, you are almost back. Now, all this is really not conditional on other events, other facts. The issue is there something in the, I mean, is that the measure of your somehow intuition or your calculation that at the end there is something that costs because of this leverage ratio being imposed across the board rather than being specifically modulated, and how large it is?
Yeah. Okay.
Can I just add one thing? If you go one slide down. So this was also my question. How much of this, for example, increase for UniCredit and Intesa is due to the leverage ratio rather than, for example, if I look at the years when this happened to the sovereign crisis in Italy, for example?
Yeah. So first of all, I want to make sure that I'm not sending the message that these credit spreads are distortions. These are actually a better reflection, a more efficient reflection of the risks to the economy of running large big bank balance sheets. So the new picture is better from the viewpoint of global market efficiency than the old situation in which banks were absorbing excess amounts of risk, but their credit costs did not reflect it. So they were not internalizing the financial stability costs they were imposing on the system. Now they are internalizing those financial stability costs through their credit spreads. The credit spreads are, I don't know if they're approaching a steady state or they'll fluctuate up and down with every minor or major crisis. But the situation is that they will continue to reflect whatever solvency risk that they have, as opposed to the pre-crisis situation, where it didn't really matter because everybody assumed, the creditors assumed that they would be bailed out. Is it costly? The research that I decided to skip over in the interest of time shows that the frictional costs for trading are almost the same as the credit spreads themselves. So for every 100 basis points of credit spread, the bank needs to make an extra 100 basis points of profit in yield terms for the trade to be profitable to its shareholders. It can be profitable on a P&L basis for the balance sheet, but to benefit the shareholders, it needs to make as much additional yield as a bid-ask spread yield as the credit spread itself. So that's, when credit spreads are 50 basis points, that's a pretty substantial wedge. And what it means is we would like to avoid necessarily going onto the bank balance sheet every time to do these trades, or if we do, we would want the bank to have better financial engineering for lowering the size of its balance sheet. And the costs in terms of volumes, well, here are in terms of prices quite high. In terms of volumes, here, for example, is the volume in the interdealer repo market, or changes in volumes in the repo market at the ends of quarters. The quantitative effects are fairly large. Bid-ask spread effects on the left-hand side diagram are also quite big. This one, by the way, is not from funding costs because repo is self-funding. This is purely a regulatory leverage ratio-based cost. The funding costs are surprisingly more important for most of these. Wherever you have unsecured debt funding, it's a bigger cost than the regulatory leverage ratio cost. Do we have other questions?
Thank you. I'm Franco Passacantando, also with a long history of Bank of Italy involvement. My question is on the procyclicality issues of the recovery and resolution regulations and the leverage ratios, because I agree with you that these credit spreads maybe better reflect the ultimate risk involved in banking. At the same time, these are relatively normal times, and it's worrisome that at times of crisis, these credit spreads would significantly go up, increasing the cost of banking funding at a time when bank funds are most needed. And also the bid-ask spreads, the leverage ratio, how that would impact at the times of crisis on bid-ask spreads at a time when liquidity is most needed in markets. So if you can comment on the procyclicality of this regulation and whether something can be done about that.
Okay, excellent question. So here's what we would expect to be the case. As financial stress builds up, we should see banks more reluctant to take positions onto their balance sheet, both because of funding costs have risen and also because capital is getting tighter under regulatory capital requirements. So both of these are pro-cyclical. In other words, if you are a mutual fund or a pension fund or an insurance company and you would like to obtain more liquidity and you call a major bank dealer during a stress period, the major bank dealer will be much more reluctant to take your position, will only take it at a substantial profit to itself in the form of a very large bid-ask spread. And at the same time, the bank executives will be asking their both lending and market-making desks to reduce the sizes of their balance sheets so that the bank will not be required to raise additional equity capital, which is even more expensive for the bank shareholders. So this latter consequence is actually probably on a global macroeconomic performance base is probably the more important one, even though it's not as pertinent to what I'm talking about today, which is day-to-day trading liquidity. So in other words, lots of pro-cyclicality.
Okay, let me take one more question by Fabrizio Sacomani, here in the first row.
I'm Fabrizio Sacomani. I also spent many years in this institution. I would like to follow up a little bit on the previous question, to ask you to elaborate a little bit on the global implications of your research, basically on 3 points. First of all, in a recent lecture, Tim Geithner asked himself, are we safer? I mean, obviously he referred to the impact on the financial cycles, boom and bust, and so forth. Second question is on, is this affecting, I mean, your research shows that, what is the impact on market making activity of banks? We hear a lot of complaints about banks. They say that, you know, we are not doing market making anymore because it's too expensive, and what is the impact then on the efficiency of markets, you know? And the third point is, what are the implications of these regulations for the apparently continuous growth of the shadow banking system? I mean, is there a danger that financial intermediation moves into unregulated areas? Thank you.
These are the top questions on anyone's list. So, are we safer? Well, even as a modest academic, I can tell you I'm sleeping much better now than I was in 2008, and I can only imagine how much sleep that you all lost in the years between 2008 and 2015. So I think, yeah, definitely we're much, much safer thanks to these regulations that I've been focusing on. And certainly in the United States and in Europe, bank capital levels are much, much higher than they were. The likelihood of failure is much, much lower. And in the event of failure, we're much safer because of bank resolution and recovery directives. The ability to recapitalize a bank very quickly and to avoid the termination of financial contracts like derivatives makes it possible, or at least much more likely, to have a solvency problem converted without causing a financial crisis. So we're much safer. Implications for market making are actually what I've been focusing most on here. And there are two effects. Number one, we were getting too much liquidity in market making pre-crisis. Okay, so market making was subsidized by government capital pre-crisis. That is no longer the case. So we are getting a more appropriate amount of market making than we had before. But the more appropriate amount is coming with frictions. And to the extent that we can, we should try to reduce those frictions wherever it doesn't cause financial stability problems. Wherever there are not bad interaction effects with your first question, are we safer? And I mentioned some areas where we can do that. One is cure some of the distortions associated with the leverage ratio rule. The second is use financial engineering and market competition to reduce the frictional costs associated with the use of bank balance sheets. The growth of shadow banking. This goes back to Mr. Dini's question, he had to leave, but Mr. Dini's question about the Volcker Rule as well. So the Volcker Rule and the regulations that I've been talking about today are encouraging market making to be done outside of the regulated banking system, where regulations, at least the ones I'm aware of in the United States, are not as aggressive from the viewpoint of financial stability. So we should be concerned, we should be vigilant. Wherever risk is growing and wherever short-term debt is being used particularly, regulators need to introduce regulation as needed. Currently, I'm not as alarmed by some at the use of things like exchange-traded funds, or mutual funds as a source of provision of non-bank market-making services. But there are other areas, non-bank lending and China wealth management products are a very dangerous development. Interbank CDs in China. China is actually a good example of shadow banking problems that could be addressed.
Okay, so one more question, Fabio Panetta.
Yeah, very short question, Fabio Panetta from the Bank of Italy. I was looking at the chart, which is now shown on the screen, and you took the increase in bid-ask spreads and the reduction in market trading as a measure of the impact of the new regulation leverage ratio. Do you have any argument to convince me that this is not due, at least to a large extent, to the QE, which has reduced to the QE, which has reduced the amount of bonds which are available, and then is, of course, driving up bid-ask spreads and reducing trading in the market?
It's a good question. So increasingly through this period, and in fact from 2008, the Fed's balance sheet grew dramatically, reducing the amount of government bonds available to the market. And that might decrease market liquidity. Bonds are harder to find, and so on. There you would see the effects more in this so-called specials repo market, where the ability to find a bond becomes more difficult. And you would also have expected to see the effect much earlier than depicted in this diagram. Quantitative easing was dramatic well before this increase in bid-ask spreads and this reduction in volumes. This coincides more with the introduction of the supplementary leverage ratio rule. So I'm pretty confident that this is not an impact of quantitative easing. Yeah, let me just leave it there.
Okay. If there are no more urgent questions, just very last one. Can you please give? You can see the interest that your lecture has created in the audience.
Thank you very much for your interesting presentation, and many thanks to the Bank of Italy for the invitation. My name is Elena Zegoeva. I'm from the Bank of Russia. And my question follows the discussion of the fact that banks now are more interested in risky assets due to the leverage ratio. But the matter of fact is that liquidity reform, capital reform is only part of Basel reforms, and the second one is new liquidity rules. And according to the liquidity coverage ratio, banks are required to have very significant amount of high-quality liquid assets to meet the LCR requirements. And do you think that the LCR can compensate that negative impact of the leverage ratio? And do you think that banks now are more interested in high-quality liquid assets and the liquidity of that market will grow? Thank you very much.
That's an excellent question. I didn't discuss liquidity requirements. The liquidity coverage ratio rule is another source of improvement in financial stability. The effect on the leverage ratio rule is actually not helpful in the sense that these high-quality liquid assets that the bank is required to hold are not available for market making. So they cannot be pledged into a repurchase agreement, and they cannot be used to provide immediacy to customers because they need to be there. A stack of these liquid assets need to be there. And in fact, because they are there as assets, they drive up the gross assets of the bank to make the minimum required amount of equity even higher, despite the fact that they're extremely safe assets. So they make this,
Even worse.
they make the blue excess amount of capital under the leverage ratio rule even smaller than it would have been without the liquidity coverage ratio rule. So it actually has from the viewpoint of safety, it's a big improvement. From the viewpoint of the liquidity concerns I mentioned today, it's going in the other direction.
Okay, I think we can now close the lecture. So let me thank you again very much for accepting and giving this very interesting lecture on behalf of the Bank of Italy and the Baffi family. Thank you very much.
Thank you, Governor.